Good evening, viewers, and it gives us immense pleasure to welcome you to our first chat on investor awareness communication or conversations on various social media platforms. And why we chose today was not because it's a bank holiday, but because it's Buddha Poornima. And Buddha Poornima has significance of a different kind. So this was the day when Gautam was born, or Siddhartha was born. This was the day when Gautama Siddhartha became Buddha, which meant the enlightened one. And this was the day when he also took or got nirvana. He took a samadhi. So it's a day which is an extremely auspicious day. It connotes learning and enlightenment. And we thought, what better day than this to start this debut of a series of conversations which we will continue going forward. So when we thought of talking to audiences beyond our investor segment, the first sect of audience that we thought was the millennials. And why we thought about the millennials was because the millennials think strikingly differently as compared to all of us. And it's therefore very important for companies such as us to understand you all better. Just to quote some examples, when a millennial is downloading an app, convenience and navigation scores over a price point. A millennial wouldn't want to buy a house. They would prefer to rent it and enjoy their life and save that money for maybe traveling outside India or within India. Millennial would prefer to take an Uber and travel rather than the old school of owning a car, navigating through crowded roads and finding parking for half an hour. And a millennial wouldn't shy away from taking a loan and buying the latest iPhone, even if it meant 2 years of EMI. There's nothing wrong in it, because in our days, these things weren't available. So when my parents, and if I insisted on buying a phone, which of course there wasn't, but even if there was, and if I insisted on buying a phone, my parents would say it's very expensive. You save for a couple of years, 1 or 2 years, and then we buy it. And I would be more or less sure that whatever I buy would be by and large safe. However, if I tell my son, you wait for 2 years, he's going to tell me the models. There'll be many models which will be launched in these 2 years, and it just doesn't make sense to wait. So this is a perspective which is very different from today's generation and our generation. There's a very, very popular film which I love, and we watched it more than once. It's about 3 young bachelor boys who travel to a European country and do things that they initially thought they were scared of. And there's one dialogue in that in which one boy is a workaholic. He loves to work and has no time for anything else because he wants to work and save as much corpus so that he can start a business at the age of 40. And in that film, that's when the girlfriend says, you live in the present. Kal kisne dekha hai? And that statement rings a bell. Actually, there's a lot of merit to that statement. And more so because we are passing through pandemic today. Kal kisne dekha hai? We need to learn to balance today and tomorrow. So this whole conversation today with you is about instant gratification and deferred gratification. And unfortunately for people like Karan and I, we are in an industry where we reward deferred gratification, and therefore this conversation becomes a lot more challenging. So in an era where waiting for even a couple of seconds for an app to open and your shortened attention spans, when we talk of 20 years of compounding, it just does not resonate. So just let me give you another analogy. You and I are on a road together. We just happen to be a little ahead of you, not because of any virtue or achievements, but just because we were born earlier. And the road is unknown to you as well as us. Maybe we are in an older vehicle, which is not as swanky, not as automated. We don't have Spotify and Bluetooth. And the way we drive or used to drive earlier was to stop by and ask, "Bhaiya, aage kya jam zyada lamba hai?" And what you do is a smarter thing, is you rely on a Google map and which makes life easy for you. But there are different seasons in, say, a place like Mumbai. There are clear skies, there are clean roads, less traffic, and you make very smart choices using that app. However, a couple of days in a year, there is rains. And rains in Mumbai are really challenging to commute. So even with a Google on your phone, you prefer to call a colleague who's left office and ask him, look here, you left half an hour back. How does it look? So he tells you, no, I have got stranded. I think you carry some biscuits and water from office. And I have taken JJ. I think it's better to take the freeway. And believe me, that information is extremely valuable at that point in time. We want to be those friends with you, and we want to share those insights just because we are a little ahead of you in that journey. And I thought of having Karan to do this difficult conversation with me. Just to give you a background, we've done a couple of conversations earlier for our investors, and Karan is a veteran in the asset management industry. He spent more than 2 decades with the industry in various leadership roles in companies such as Goldman Sachs, Franklin Templeton, Aditya Birla Capital, and Axis Mutual Fund. He hung up his boots to do something he likes, which is he's a sports. But just before I do that, this much doesn't qualify him to do this talk. In fact, when he told me this, I said, no, send me something more. It doesn't appeal. And then he said, he's a sports enthusiast, and the audience I'm talking to is into gaming. He's a coffee connoisseur, and I see only you all in stores like Starbucks. So that connects. And apparently he's an eBay shopper, which I am not. So he technically qualifies to talk because he has probably crossed that bridge to come closer to you all and talk about just very, very simple concepts. Now, we are not going to be preaching. We are just going to be doing some basic conversations. And these are insights just the way we are a little ahead on the road, just because we were born earlier. And those insights could be valuable inputs for you to charter your route in this life, because you all are ambitious. You all are from the startup generations. Millionaire actually does not appeal to many. You all are talking of billionaires. In fact, on Sunday, there was an article of Ruchi Sharma which says there are so many more billionaires which got added in this world during this pandemic. Your aspirations are higher than what we used to have. And therefore, your need for this conversation is very, very important. And with that little start of the conversation, I would like to request Karan to take it over. Over to you, Karan. Thank you so much.
Thanks a lot, Shamli. So many beautiful examples you've given to set the tone on this one. I think the equivalence of what the millennials face today and what you and me have faced in the past, that was a bit of a drive down the nostalgia road. It's quite interesting that, yeah, of course, the world has changed and buying patterns have changed, but I was thinking about this, but in the world of investing, some fundamental rules actually haven't changed. I mean, and I think they seem to be getting stronger. If anything, they seem to be getting stronger. And one of which, and we'll talk about some of them, but like one of which is about longevity and the fact that there's a difference between making money and creating wealth. And I think those subtle differences is something that we'll talk about today. And Shamli, you were absolutely right. We'll try not to get very preachy about it. I have put together some slides. Hopefully the slides are only photographs, and some of those photographs by way of illustrations is what we'll try and explain this whole concept of, are you here to make money or are you here to create wealth? That difference is huge. I mean, it can literally mean whether you want to retire at 45 or whether you want to retire at 65. So for a lot of people on this call, if you all are just got into the job world and if you're like just about starting and you're like at what, 23, 24, 25, you have the option of thinking that at 45 you could literally walk away. But all of that requires rigor, discipline, etc., and we'll talk about that. Just before I get into the slides, I wanted to thank Shamli and HDFC team for having, given me this opportunity. Also, the team's really worked hard last 2-3 days to put this together. So kudos to everyone who's worked at the back end to put this all together. And clearly, no better time than Buddha Poornima to bring this out. And I think, Shamli, it's a great start for the AMC to kind of propagate this whole thought process of investing for millennials. So what I'll do is over the next, just give me 30 seconds. I'll start my slides. So we'll start with the slides. I'll talk about some of the slides, some of my own learnings and experiences. After which we'll take Q&A from the team that's kind of come on board and whoever is listening to us. So just give me 30 seconds. I'll start my slides. Okay. And very aptly, we've tried to play with the words and called it millennials turning into millionaires. I think that's true because you've got to be ambitious enough to think of yourself while you're whatever age you are at. The fact of the matter is that if you got this right, if you kind of managed and navigated it correctly, the chances of many of y'all ending up as millionaires is actually there. So that pot of gold is available. It's just the ability to stay there and kind of do the right things and make sure that you're actually available at the end to reap the benefits. So, which is why we titled it Millennials to Millionaires. And I'll start straight with my slides. Okay. India is one of those rare countries in the world. In fact, culturally, it's perhaps the rarest that money is truly worshipped. And you can see that all around you. Look at Goddess Lakshmi. Look at Diwali. Look at the way we look at the relationship Indians have with money. It is not just a capitalist thought process for us. The fact that we worship money means that the importance of money in our life and in our lives is significant. What I wanted to actually, kind of explain through this concept was that money for us Indians is not just about the ability to purchase any item. It in fact has an even bigger layer of importance in our lives. And so, like I said, Lakshmi is the goddess of wealth. But this photograph that you see on the left is not of Lakshmi, it is Kuber. Now, he is the actual king of wealth. And he's the kind of repository of money. And like I said, this relationship has been culturally imbibed in us, and it kind of showcases that for Indians, money is not just, like I said, not just about a buying pattern, but something that kind of culturally binds us together. With that background, let me come straight to the next slide. Over the years, I have figured out, and these 4 quadrants are my own, and I don't work anymore, and hence one of those quadrants is not important for me, at least for now. So the rest of the 3 are really, really critical. But for a lot of people on this call, perhaps all 4 are important. So you got to take care of your health. There is a work that you're into. There are relationships that you kind of forge. And the 4th quadrant is that of wealth. So if you get the 4 pieces right, actually it's life enriching. एंड दैट इज वाई मैंने सोचा कि ये जो मेरे 4 क्वाड्रेंट्स हैं जो मैंने अपनी लाइफ में इनको इन सम वेज आई एम ट्राइंग टू लिव दीज 4 इन माय ओन वर्ल्ड, व्हाई डोंट आई शेयर दैट विद अ वाइडर ऑडियंस. So there is no bigger investment than investment in yourself, and hence your investment back in yourself through making sure that you are fit. And this pandemic has showed us that if you are reasonably fit, your ability to handle stress, your ability to handle ill health is far, far better. What I also want to share with you is relationships and work. And you'll notice this as you spend more time doing your work and looking at your relationships, that while there can be sometimes a balance issue, finally you will figure it out. But the 4th quadrant is the one on wealth. That's the one which we aim for, but perhaps don't spend enough time, energy, and effort to put everything together, which is why the fourth quadrant of wealth is something that I want to spend extra time on today. Having said that, if you don't remain fit, if you're not playing a game, if you're not into sports, if you're not working out, having all the wealth in the world is not really going to help you. So keep that in mind. And in many ways, my single biggest advice to everyone would be that focus on your fitness, and wealth creation actually is a process that happens along with it. So I'm going to spend some time on the process of wealth. Let's just understand some more about it. Very basic question: why do we need money? And it may sound very simplistic. Factors of assets, you need money for a variety of things, and let's just look at what do we need money for. It could be for what I love most, drinking coffee. It could be for petrol, buying, shopping, movies, weekends. I mean, so money in our lives has a direct and material impact on the quality of our lives. It could very well be some of the short-term needs. So you've got shopping and traveling and whatever. But money also has longer-term implications, such as at some stage you would want to buy the Mercedes, you will want to buy that lovely home, you'd probably want to get married, get your children educated, and finally you will want to, enjoy life, do what you really think you deserve to do, which is probably your passion, what you're deeply passionate about. So if you look at between the two slides, there is so between this slide, which is all about immediate usage of money, and the next slide, which is about potential usage of money, there are two separate aspects altogether. And many times what happens is we tend to believe that कि जब हमको घर खरीदना है तो उस वक्त इन्वेस्टिंग स्टार्ट करेंगे, अभी तो मेरे पास पैसे ही नहीं है. Now that's the issue I wanted to speak about, and subsequent slides will cover that the process of creating wealth, the process of wanting to save, the process of trying to build a corpus, those rules haven't changed. Whether you're a millennial or you're kind of my age at 50, it doesn't, those rules haven't changed. And that's why fundamentally, the quicker we learn them, the quicker we imbibe them, and the quicker we absorb them, the better the journey becomes. And one of the reasons, and Shamli mentioned this, one of the reasons that I could walk off from the corporate world is also the fact that I had been investing from the time when I was 25. It's not that I had too much money at the age of 25. I didn't have money at the age of 25, but what I got into was the discipline of investing at the age of 25, which actually helped me when I was 45. So I'll explain a bit more of that. Let's go to the next slide. This I picked up, very interesting slide, and this you can, all of us on this call, in fact, I relate to this very, very well. And I'm sure when I explain this, you'll understand what I'm trying to say. So let's assume that there are three layers of people. So Gen Z, let's say people on this call, for lack of a better word, Gen Z, millennials, whatever. I mean, you can label whatever you want to. Let's say people on this call are Gen Z. And now I'm asking you to think about your father. And now I'm asking also to think about your grandfather. What you'll notice is the yellow bar, which is the retirement years in each of those segments has actually increased. So Gen Z will actually have the highest period of retirement years. Your father had relatively lesser retirement years, and your grandfather had the least number of retirement years. The point I'm making is that our fathers and our grandfathers had the highest number of earning years, because conceptually, grandfather, father, they used to work till 70. For them, retirement was 72, 73. When my dad retired from the Indian Air Force, he was already around the 60 mark. He was already at the 60, 62 mark. And I'm not Gen Z, but I've already retired at 48. So you can see that as the time goes by, the next generation has lesser number of years to work and a much bigger number of years when it comes to non-work. In many ways, the point I'm trying to make is that your retirement years will actually be much more or equal to your working years. And hence there will come a phase in life when your corpus that you build will actually fund your retirement, or for that matter, anything that you want to pursue. But those number of years is starting to decrease. It's decreasing for two reasons. One, I think the intent to work also beyond a point is starting to shrink. And second, rules and regulations around working years is also starting to shrink. So it's a combination of multiple factors. But the more you think about it, more you realize that my daughter is 21. And by the time she thinks of leaving, I can't see her working beyond 43, 44. She's 21. I can't see her working till 50, 60. No way. Or maybe I'm wrong, but whatever it is. Fact of the matter is that the earning years are shrinking and the retirement years for this generation are increasing. And hence the concept of starting is becoming even more important. I wanted to, kind of take an example of someone who I think everyone adores. This example is of clearly the fastest man on earth is the sprinter Usain Bolt. Now, there's a reason why I'm sharing this with all of you. In the world of 100-meter sprinting, Usain Bolt now clocks 9.86 seconds. So he's completing a 100-meter race in less than 10 seconds. Okay. And he's the fastest man. I mean, whatever, everyone knows about that. That's not the real story. What I wanted to share with all of you are the statistics behind Usain Bolt. A lot of time we speak highly about marathoners and that this is a marathon, not a sprint. I'm now going to turn this around and give you an example of a sprinter who's actually training as if it's a 20-year marathon. So let's look at Usain Bolt. Look at his numbers and you'll realize what I'm trying to say. Everything comes with efforts of decades. And so look at the numbers here. He's won 9 gold medals, 3 Olympics. He's actually spent less than 2 minutes on the tracks competitively. So basically the 115 seconds is a accumulation of all those races he ran competitively, less than 10 seconds, but he obviously ran at least 20 races. So while he was competing, his entire time frame was less than 2 minutes, 115 seconds. Now those 115 seconds got him, let's say, $120 million and the biggest name on planet Earth. But do you realize that to reach those 115 seconds, which is less than 2 minutes, he actually trained for 20 plus years. So here is a person, by the time I complete this sentence, would have run 100 meters. And the fact that he's to do that, he's trained for 20 years. And that is the beauty about decadal efforts, that once you are committed and once you kind of devote yourself to decades of effort, the results are so large, they're actually outsized. They're outsized results. So I'm not taking the example of a marathoner, but I'm taking the example of a sprinter who's trained for 20 years, but was only there on the tracks for 115 seconds. Everyone completely understands the eighth wonder of the world, which is compounding. And I'm going to give you two very, very simple, basic examples of how compounding really works. I'm sure all of you have heard of these two examples, but I still wanted to share these two examples with all of you because they're super, super critical for the simplicity of what they bring to the table, and yet understanding, once again reiterating it, कि हमारे दिमाग में ये बैठ जाए कि ये eighth wonder of the world अगर हमने समझ लिया, and if we get this right, its unlocking is quite supreme. So let me give you the two examples and let me get into the first one. ये पहला वाला एग्जांपल सबने देखा हुआ है. इसमें कुछ इसमें कोई रॉकेट साइंस इन दैट सेंस नहीं है, बट आई स्टिल वांट टू शेयर दिस विद यू. ये है चेस बोर्ड है, सो 8x8 वाला चेस बोर्ड है. नाउ if you put double the grains on every square, what you'll notice, 2 becomes 4, 4 becomes 8, 8, 16, stuff like that. By the 16th square, square, you do get to 32,768 grains, as is visible on this screen. The 32,000 grains by the 20th square become 5,24,000 grains. And as you increase the squares, it turns to millions. And by the end of it, it's 1,500 times the global production of wheat in the world. 1,500 times the production of wheat in the world. Now that is how those boxes kind of showcase the power of compounding. And it didn't show up till the 20th, or it won't even show up till the 30th square. All of it will show up, will start showing up in the 50th square, in the 55th square. And so that is why in the 54th square, the point being that while the start is slow, the end results are huge. And I'll take another example to explain what I meant. This is another example used extensively, and I, again, just bringing it out, reiterating it. Look at this question and try and answer this in your heads. So there is this pond out here. It has this very special lotus which doubles every day. Because this lotus doubles every day, the pond will get filled in 30 days. Now, if the pond is full in 30 days, when was it half full? When do you think the pond was half full? Now, if you think very quickly, ना, वो ऐसा लगेगा कि 30 days में अगर वो डबल हो रहा है, अगर लोटस डबल हो रहा है, तो कौन से दिन में जाके, कौन से दिन पे ये हाफ फुल होगा? Logically 30 days, so उसका आधा 15th day. No, it is not half full on the 15th day. It's half full on the 29th day because it's doubling, no? So even that means to get the pond full, you have to wait till the 29th day. तब जाके 30th day को full होगा. And so while the power of compounding is extremely large and it is material, fact of the matter is till you don't see it through, it won't show up in our lives. And that is perhaps what Shamli was alluding to in those subtle differences between instant gratification and delayed gratification. And perhaps, this whole concept of delaying our gratification has outsized returns, that if some of us manage to link into it and kind of hold on to it, some of the millennials on this call will end up becoming millionaires. And I'm going to give you two very simple examples by way of mathematics. At the end of it, some of these have to, really sit in our heads. And I'm sure, these calculations have been done umpteen number of times, but it still brings out how big those numbers can be. Assuming some of you are at 25 and some of you are, let's say, at 35, two women, Aishwarya and Sushmita, pure coincidence. And one of them starts at 25, the other starts at 35. Now, even if Aishwarya has just started with 10,000 rupees, but she had the advantage of starting 10 years earlier. So let's say she wants to walk off from her job at the age of 45, she has 20 years to go. And Sushmita started 10 years later, but she started with 30,000 rupees. So her saving number of years is 10. She's got 10 years to do this. Fact of the matter is that if you look at the two arrows, the total investment made by Aishwarya is actually 24 lakhs, but that becomes 1.5 crores. And while Sushmita invested 3 times higher, but because she only had 10 years, it's just about less than a crore. And that's how big the gap is. So just starting early with even 1/3 the amount has a dramatic effect over a 20-year period. Now, if I show you another slide, how big the gap could be if 45 ki jagah, it becomes, instead of doing, 45 years, if they wanted to work till 55 years, and Aishwarya invests 20,000 and Sushmita invests 50,000. Look at the difference. Aishwarya will end up with 14 crores, Sushmita with 7.5 crores. So in both the examples, if you notice, it's not about how much you started with, it's about how quickly you started. How quickly you started, how well you kind of maintained yourself to kind of go the distance, not getting psyched out or swayed by whatever comes in the way. Now, it sounds very easy for me to say all this, but there are many examples where people have done it. And So if you start trusting these numbers, what you'll notice is that the initial investment, like let's just take the first example, a 10,000 rupee or a 30,000 or a 5,000 or a 7,000 doesn't mean that this is forever. And that's the point I'll come to in the subsequent slides. Doesn't mean that this 10 is that अगर 5 से start किया तो जिंदगी 5 में ही रह जाएगी. Not at all. As you become 25 से 30, 30 से 35, your salaries will increase, your bonuses will increase, you probably start your own work. So 5 will become 50,000 at some stage. But the discipline and the rigor and the effort has to start much earlier. So many people ask me, how much should I invest? कितना पैसे नहीं है? The favorite answer for everyone, मेरे पास तो पैसे ही नहीं है. My answer to that is exactly like that of making an effort on your fitness. Time nahi hai. I have too much work. Look, if you think that you don't have the time to invest in the only thing that God has granted to you, which is your body and your mind, if you think you don't have the time for that, then at some stage it comes and hits us back. Same thing, if you think that you don't have the money to invest, then there is something technically that is not getting, then it's not coming into our scheme of things, that how important it is to keep that little money aside. Little, even littler, doesn't matter. And so this question of how much should I invest, in my mind, is actually immaterial. And the real answer is, it doesn't matter. It doesn't matter. There are people, when I started working out, or if I work out after a long period, I never start all out. I start with very low weights, start with very short runs. Everything is short, short, chota, chota. So कितना करना है, कितने से पैसे बनेंगे, it doesn't matter. What matters is start करो and be regular. अगर start ही नहीं हुआ, और अगर हमने वो जर्नी पे हम लोग निकले ही नहीं, so it just becomes immaterial. So as is with fitness and making money, please start. The sizes are immaterial. And at some stage, as you start making more money, as things get better, those sizes do increase. And the other thing, the other thing which, of course, I've kind of established by now, that to kind of reach this level of fitness, it doesn't happen overnight. And to become a millionaire, it doesn't happen overnight unless you kind of, inherit something and whatever, luck favors you or whatever. When it takes time, yeah. Why should it be like just because हमने start कर दिया है, it's not a right that, we'll make money. It just takes time. And which is why I'm constantly reiterating the fact that here amounts don't matter, time does. Are investments risky? Of course they are. And but and this you will learn a lot. I mean, this concept of in college we've all been taught that high risk is equal to high return. Actually, now that's turning onto its head. It's not necessary that high risk is equal to high returns. Sometimes low risk is also equal to high returns. So the way one has to establish relationships with risk and volatility is important. How do you view risk? How do you view volatility? Do you run away from volatility? Are you able to handle all of that? Now, those are very emotional questions as well, because risk is inherent in every aspect of life. Let me explain what I meant. These are two options for you to travel. One is a car, one is an aircraft. Research has proven that the chances of us getting hit by an accident in a car are much higher than the accident in an aircraft. Though in our minds, flying is riskier. But research has proven it the other way around, that traveling by car is actually far riskier than flying. I'll give you another example. There are three options out here. Which do you think is the riskiest? Now, there's selfie, there's bungee jumping, and parkour. Now, anyone would think, or at least, I mean, just basic level logical thinking is bungee jumping is the riskiest, perhaps parkour, and then selfies. Again, as research has suggested and has shown, actually selfies was the riskiest thing, and many deaths happened because of selfies than because of bungee and parkour jumping. Now, the point I'm trying to establish out here is that the relationship that we have with risk, the relationship we have with volatility, is perhaps very, very critical in understanding our relationship with money itself. And that is why there is a huge difference between risk and uncertainty. We got to be careful of uncertainty. Now, this photograph that you see on the right hand side is an uncertain kind of, paths are crisscrossing, tires are going here and there. It happens when we are not comfortable with what we want to do. Whereas the photograph on the left is a very, very tough balancing act. There's a crocodile waiting to grab that man, but the guy has got his balance right and he's trying to walk the tightrope. And I think that is why it's very critical to understand that risk doesn't mean loss, but being uncertain can sometimes lead to loss. So we say this very often in the world of mutual funds: risk is actually a friend, volatility is a friend, upward and downward movement of prices are friends. So if we look at it from that point of view, life becomes slightly more sorted. Uncertainty can be a bit tough because what basically it means that with every up down, every movement, our decisions will change. Now that can have deep ramifications on portfolios over time. And hence, what I'm trying to say is that risk is an integral part of life. We got to embrace it, and there are many ways to handle it. And this is a classic case of how risk is embedded in our lives. This is Nifty. This is movement of Nifty 50 from 95 onwards. You can see that we've had some of you won't even know what these crises are: Asian crisis, tech bubble. Shamli and I have lived through many of these, and we survived, both in our jobs and while creating some wealth. Factors that we've seen enough number of crises, and every crisis has led to an opportunity. So Asian crisis, tech bubble. I want to show you one particular phase where markets did nothing for 4 years. Look at the tech bubble, Jan 2000 to Jan 2004. Trust me, those 4 years were the toughest. At least I haven't faced a tougher phase than 2000 to 2004. The markets didn't do anything for 4 years. Can you imagine how tough it is to live in a sideways market जहाँ कुछ नहीं हो रहा है, dull, boring? The best performing fund used to be minus 10%. So people used to give awards. This is the best equity fund. It's delivered minus 10% or minus 15. And imagine this for 3 years, 4 years. So it's really tough. But as soon as 2004 finished and corporate earnings got better, and I don't want to get into those details, but 2004 inflection, 2004 to 2008, look at where the markets went. And from 2000, the Nifty went almost all the way up to 6.5, 7,000. So that waiting period of 3 years, 4 years resulted in creating wealth from 2004 onwards up until 2008. Even post financial crisis, severe dip, big pullback. COVID, severe drop, massive pullback. So, and all of them were risks, by the way. If at that time we got uncertain, we would probably not have lived to see the better journey. So, embrace risk, it's a friend. Options क्या हैं investing के? Options, बहुत सारे options हैं, but मेरा favorite option is mutual funds. I am a big fan of mutual funds. बहुत advantages हैं. In fact, the biggest advantage is, why do you want to do it on your own? I mean, why do you want to spend all your time looking at stocks and different aspects of what's happening in the world? I mean, unless you're passionate about it. But if you are like, if you're in the world of creating content, if you're a marketing person, if you're into brands, if you're into sales, why would you want to spend your time? Why don't you just look at a few good fund houses, look at the effort that they are making? They're doing everything on your behalf, so why would you want to double down on that and do it yourself? They hire the best brains to look at funds. It's it's the most transparent product available, brilliantly regulated. It's got transparency, and I think the entire benefit of investing in mutual funds far outstrips kind of doing this on your own. And so I would always urge people to look at funds as the first steps towards their world of investing. And like mutual funds say, yes, seems to have really caught the fancy of a lot of people. And clearly, retail India and investors are starting to pour money into it. But there's one difference that I want to suggest today, which is very, very, very important. And I'm going to share my personal experience on that one. Perhaps this is the biggest difference I'm going to share. If you look at the photograph out here, this is Krishna talking to Arjuna and giving him advice. And this is something I'd certainly urge you to do at your journey of investing. Please seek advice, please seek help, please seek out someone who will be your सारथी. किसी कोई एक होना चाहिए जिसको ये knowledge of financial world हो, not because he's technically sound, but because वो emotions के साथ भी deal कर सके. As you spend more time in the world of investing, you will realize that this world is not just mathematics. It's actually more about emotions than anything else. I have spent 25 years in the world of investing and doing mutual funds. I have an advisor who helps me put my finances in order when the markets fall and when I'm very, wondering what's going on. I seek his advice. He's a good fund manager. He's a good stock picker. He's also a good mutual fund guy, but he is my anchor. He's my emotional support when I need him. He's almost like a family member. The reason why I seek his advice is not to maximize my returns. No, I seek his advice to keep me on the path. And keeping me on the path is the most important aspect of wealth creation. And please remember, Krishna never picked up any weapons or arms in the war during Mahabharata. He never picked up a single weapon. But without him, the war could not have been won because of his advice that he kept constantly giving to Arjuna. And that is why I seriously think that the do it yourself concept, I would be very wary of that, because it seems that it kind of means that it's the easiest thing to do. No, it's not the easiest thing to do. Start buying mutual funds, take help, seek advice, because this is not a 10-month journey. What you are embarking on is a 25-30-year journey. And in those 30 years, you will encounter at least 10 hugely impactful decision-making moments where you need help. And hence, I cannot emphasize more the importance of someone who can guide you, help you, be your Krishna. And finally, I have a couple of slides which are very unrelated to the world of investing, but deeply impactful in terms of in terms of the message. This century has witnessed two things. In fact, please look at the dates. In 1903, December 17th, Wright brothers kind of, uh, took the first flight human being has ever seen. And look at the photograph on the right. In less than 70 years, in one generation, from barely flying above ground, man was on the moon. In less than one generation, which is like 65 years. And I'm going to come back to this photograph, but from this concept of taking a little bit of flight to being on the moon in 65 years means if someone at 1903 or was 17 years old or 20 years old, by the time that person was 80, man had landed on the moon. So sometimes it doesn't take centuries to make dramatic changes. It can happen in one generation. But the funny thing is in 1903, no one covered the first flight. So look at the photograph again, December 17th, 1903, Wright brothers take that first flight, but no one covered it in media. 18th, 19th, 20th, 22nd, 23rd तक 22nd तक किसी ने नहीं cover किया, किसी ने नहीं. और by that time, Wright brothers had done 19 flights. कहने का मतलब है sometimes the most obvious, most glaring changes that happen in front of us get missed out. And people don't acknowledge it, they don't factor it in, but they can be life altering. And one of them was flight. Flight was not even captured, it was not even in the imagination. When New York Times wrote about it, it said very, 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 very far future, they may be flying machine. Now, very, very far future, 60 years, man was on the moon. And so the point I'm just trying to make is that these changes are happening in front of us. You don't have to wait for a headline saying that, oh, you can create wealth in 20 years. it does happen. You don't need headlines saying that seek advice. You don't need headlines saying that look at mutual funds. This is all happening around you. In case in case you need proof, just go and look at fact sheets of some of the AMCs. You'll get to know. And the last thing is, I started with the fact that our relationship with money in India is that money is worship. The last slide I want to show you is that while Kuber is the god of money, उसका जो vehicle है, just like Ganesh ji's vehicle is चूहा, कुबेर का जो vehicle है, that is human beings. So I want to end by saying that the vehicle that Lord Kuber uses is human beings. That is the end analogy I want to give, that human beings are the vehicles for wealth. Human beings are the vehicles for God Kuber. Understand your roles, understand the importance of what this is all about, and you'll definitely be on the road to create wealth. So with that, I'll take a short break. I just wanted to end by saying that, in summary, if you look at the 4 points, the one that matters the most is start early. Doesn't matter how much you start with, just start early, get into the discipline, work out, play a sport, and invest well, seek help, and you will, from a millennial, some ways you'll become a millionaire, because this at least it worked for me, because I kind of did some of these at the right time. I had advice. I looked at mutual funds. I was lucky enough to be at a time when the country was growing. And if it could work for me, I'm sure it can work for you too. So with that, I'm going to give it a short break. But before that, I've looked at the HDFC MF Bytes. It's a pretty good app. Have a look at it. Uh, Plenty of learnings from there, gamification, etc., and then so much to learn in terms of just simple concepts of investing. So have a look at that. I'm going to stop here and get in Shamli to step in and kind of take it from here onwards.
Yeah, thank you so much, Karan. Thank you. Thank you. That was very, very interesting. And before I start the question and answers, I see some questions have already started to come in. But before I start that, I just wanted to talk a little more about MF Bytes. MF Bytes is a investor awareness app, first of its kind from a mutual fund company. It has been built so that we can come closest to what a millennial would want. They're very simple 8 chapters, and there are some 64 quizzes. Just try and go through that and navigate. If you get intrigued by what Karan spoke today, and if you do want to know a little more about it, there are a whole lot of avenues. But this is one of them that you could also check out. It's a simple thing, and it would be great to have you get certified. And it'll give you information for a person who's just starting to know about mutual funds, to someone who wants to know a little more about it and have understand more complicated terms that we use in our fact sheets, like Napoleon, duration, etc. So it just graduates you from a very low level of understanding to a fairly decent level of understanding. And of course, there's a lot more that you need to do after that. So we will deal with the question. In fact, we were anticipating this. There are plenty of questions on cryptocurrencies, Karan.
Yeah.
And they are saying that everyone wants to double money in the shortest possible time. And crypto seems to be serving that purpose. They also acknowledge that crypto is not governed. However, it's too tempting to avoid. When you see people make 15-20% in a day, and it is a 24/7 kind of an exchange. How do you deal with such short and easy to make monies which are available today, which were not available when you and I were starting our investment journey?
And I think it's a fair question also, because it's a brand new invention in many ways. So it could very well be the Wright brothers moment for investing. So here is the first disclaimer. I'm not a cryptocurrency expert at all, and I don't understand that world. Another disclaimer, I'm not invested in it. Do I miss it? No, certainly not. I'll tell you why. And let me just explain this in a slightly different manner so that we get clarity on it. I give you two options. You have the option of earning. So if it's a 10-year journey, you have two options. You have the option of earning 100% returns in year one. Okay. But the next 9 years, you don't make any money. But you make 100%, you double your money in the first year, and then for 9 years, it goes nowhere. You complete your 10-year phase. You have a second option of earning 9%, 10% every year, but for the next 10 years. Which one do you think a person would go for? The 10% every year for the next 10 years, or the 100% first year and nothing for 9 years? Chances that the 100% is very, very alluring. It's very appealing. It just makes sense कि हाँ एक बारी बना लिया तो अगर नहीं भी बना अगले 9 साल कोई बात नहीं. And that in a way is how I look at the advent of not just cryptocurrency but many other things. It's just not crypto which is going up. It's commodities. It's at some stage it was gold, it was silver, and so we've had at some stage it was even currency. So it's not as if crypto has come and changed lives, that things can go up 100%, 200%. Things have happened in the past. But if you go by that example, you'll notice that if you were to make 10% every year for the next 10 years, the compounding effect is way bigger than making 100% in 1 year. And so it all comes down to the basics of investing, which is stay there, stay put, take the right risks, seek help, and take a 20-year view. If you look at all of that, public markets, well-governed markets, regularized markets, transparent markets, where you know what's going on, to my mind, seems like the right option, at least for now. And which is why the whole issue around stocks and mutual funds.
That's true. I'll just add to what you said. In anybody who's achieved something in the world of investing, they say just one thing, that invest in things that you understand. Till you don't understand, no matter how appealing it is, stay away, because you don't know how badly it could hit you. So just to give you an example, if you have 100 rupees, right, and you lose say 50% because of some unknown, unresearched stock or crypto, or be it anything, it can be anything. So your money halves from 100 to 50 in just one day. However, it has to go up. It's just half 50%. However, you have to go 100% from 50 to reach your capital. So it takes a lot of effort to come from, to regain stance from an eroded portfolio perspective. If you've lost your capital, don't make mistakes. As Warren Buffett says, that it's best not to make mistakes. It's okay if you earn a bit less, but one mistake could be far more detrimental to the process of wealth creation. There's another question here, which says that there have been so because of the pandemic and the fact that we did not consume and we did not spend money because the malls were shut, shopping was shut, only essentials were delivered, people had some surplus funds. So even in the US, only the home improvement companies did well, because when people were staying over homebound, they thought they needed another room, a more comfortable place, because in earlier days, one would just come at night and go to sleep. But however, if you were to work 24/7 there, you need to make your house a little more livable. So that expenditure went up. And then there were a whole lot of accounts, whether it was Robinhood or Demat accounts in India. So there were over 1 crore Demat accounts opened up in India. And people did well too. I mean, I don't know anyone. We are not supposed to invest in stocks, but I'm assuming if people are so excited about this whole Demat and stock trading, I'm sure they've done well, because last year the markets gave them a situation, an opportunity. When the markets tanked almost 50% because of COVID and lockdowns announced worldwide, and nobody at that point in time had anticipated markets to regain and in fact exceed the pre-COVID levels. However, people who did dabble in stocks, they seem to have done exceedingly well. Now, from whether you call it beginner's luck or maybe they call us the story of sour grapes, nonetheless, they made money. Right? There's nothing wrong if you make money on stocks. how would you motivate people? And there are more people who are in stocks than in mutual funds today, the new investors. How would you motivate them to come from one stock market to a diversified portfolio which mutes your return and mutes your risk as well, however, mutes your return?
Yeah, so I'll answer that question. I understand, and there are kind of related question that has come on index and passive versus active. So I won't club the two answers, but we'll address that as well. So the question that has been really asked is that stock investing has really helped. Person who's gone onto the app, punched the numbers, and bought stock is capable of doing a job, capable of running a home, capable of analyzing stocks, capable of speaking to managements, capable of looking at industries that those stocks are bought in, tracking their numbers, figuring out whether that management is on the right track or not, taking a decision on buy and sell. And by definition, that person, he or she is Superman stroke Superwoman. I just find that concept slightly tough to accept. So the simple reason that managing money is a full-time professional job. It is not a half-time 20 minutes stock dekh liya and sab theek hai. It doesn't work that way. It may work in patches of 2 to 3 years, but over decades, it requires tremendous amount of work, insight. In fact, if you're a professional at it, you're good. If you're not a professional at it, if that is not how you earn your money, then it's best to leave it to experts. And the experts in this case happen to be mutual fund guys who do this for a living. So I would assume that someone who's doing it simply because the belief is it's easy to make money versus someone who does it professionally, zameen asman ka farak hai. I'm not dissing them, but I'm just saying that think of it logically, right? It's like saying the easiest example I can think of is you won't want to self-medicate in slightly serious cases, right? That's the easiest example I could give. And so to that extent, depending on managers, taking advice, going for the full hog, staying to your plan, knowing why you invested, all of that is far more important than making that money for 18 months. And the last thing I'll probably cap off on this is that what if, how do you handle a situation if your portfolio drops by 50% today? What do you do? There is no rule which says that now that you have invested, you are bound to make money. In fact, remember this one thing, that the day we all invest is when we are guaranteed that the markets will fall, because that means tremendous optimism. Real wealth is made when there is pessimism. When people are like
Doom,
running
doom
away.
and doom.
If there is too much optimism, the potential gains keep dropping off. And that's when you need even more advice and even more professional service. So if you want, Shamni, you can add to that. Otherwise, we can take that question on active versus passive, because that's starting to.
Yes, in fact, there are many questions on that, active versus
You
passive.
want me to answer that on active versus passive? You want me to take that on right now?
Yeah, of course. Oh, I can take it, but I'll add on if I want.
I'll give my 2 bits on it, and then please let me know what you think. See, what has happened is there's obviously this big transition happening to passives, which is clear. I mean, that's globally, that's a trend, no doubt about it. In fact, it'll get bigger. But it's coming in different forms and different waves. When I looked at this number 10 years ago, uh, it was insignificant. 5 years ago, it started to make a difference. Today, it is significant. Having said that, in India, the potential to this debate in India of active versus passive is still not necessarily the right debate, because many times we don't even start. The point I'm trying to make is, if you as an investor feel comfortable buying passives, please go ahead and buy them. If you think actives make sense, buy them. What we tend to do is debate it no end, but buy nothing. My own view on this is, India is still a market where active fund management, good active fund management can still create alpha net of expenses. I still think Indian fund managers and the Indian markets probably will give anything upwards of 1.5 to 2% alpha because there are opportunities yet. Perhaps in 5 years, that opportunity will disappear. But at least for the next 5 to 6 years, I think active fund management still has room for outsized returns.
I think the whole debate of active and passive has got accentuated over the last 2, 3 years. And the reason for that is that if you were to do a return attribution of, say, Nifty, the top 5 contributors to Nifty are actually contributing anywhere between 80 to 150% of the Nifty returns.
True.
Right? When that happens, when out of a benchmark of 50 stocks, 5 contribute to 100% of the return and others don't, this happens in polarized markets. When the market index looks at 50, however, the other stocks are not there, are just not up there. I'm just giving you examples of numbers just to for easy understanding. Now, what happens? These are called narrow-based rallies, right? So it's not always that only 5 stocks will contribute to 100% of your overall benchmark returns. When the economy does well, when all segments of the economy or almost all segments of the economy do well, then we see a broad-based rally, right? That then, if we come to a situation when, say, power is doing well, pharma is doing well, IT is doing well, banks are doing well. Now, those are the situations which actually reflect that the economy is doing well, right? In the last so if you were to compute the Nifty returns over the last 10 years, they are in the range of 9 and 10%. So the returns have not been great of the benchmark. And even that has become challenged because all 50 stocks of Nifty have not contributed to that. Only a handful of them have. And which is why investors who are invested in active funds, which are non-index based funds, have not made as much return as the index based funds. However, and that's how the whole genesis of this debate of active versus passive. There is nothing right or wrong. It's a way you can evolve as an investor. And so in the US, for example, when there is very little alpha to deliver, and this polarization has not only happened in India, you must have heard of FANGs, right? Those 5, 6 stocks which have actually pulled the market up even in the US, right? So polarization happens in all markets, right? But when the economy does well, it will not only be the 5, but it will be 50 more or 60 more or 100 more that will contribute to the overall growth of the company. And in the listed space, if the companies grow, their prices will also grow. Now, in this time, what has happened is that, of course, we are not at 26,000, we are at 50,000. So the stocks, by and large, don't look cheap. But however, if you have a broad-based rally, there will be some which are still looking reasonable. So, nobody to advise, but if you were to invest and if you feel that you're okay with investing in the benchmarks, which in a way signify they're the symbols of the economy or the markets per se, please do invest. And if you think that the economy is going to do well and it will be other beyond these 30 or 50 stocks which will eventually do well, you should invest in an actively managed fund. Because if you were to invest in a Nifty or an index, you don't get to invest in a small and a mid cap, right? So just a perspective, no right. In fact, investment is more of an art than science. There's no right or wrong. It just depends on what your risk ability or risk taking ability is, what your personal cash flow requirements are, how much you can, how much of risk you can absorb. So if you are starting into stocks and if you want to stay into large established companies, you can take an index fund or, those are all large established companies. However, once you evolve over time and you learn about and you get deeper into in terms of your knowledge, in terms of what the other stocks are also offering or what other companies are also doing, you do invest. So there's nothing as the last day to invest or the best time to invest. Don't just chase returns. That is the most important statement that I would like to make. Because what happened a couple of years ago was one segment of the market became awfully expensive. And what happens is, even if we say that mutual funds are subject to market risks, please read the offer document before investing. What excites an investor is to see the last 1 month return, 2 month return, 1 year return. Do not do that. Please diversify your portfolio, and what's got you here will not get you there. So please understand. So for all that, you either need an advisor or an expert, a mutual fund expert, to help you understand, because initially it may be difficult or complicated. Or second, rely on a fund manager who understands it much better than you and me today, right? So that as much of that for active versus passive.
There are two neat questions that have come. I thought I'll just read them out. One was actually a question saying that I didn't start investing early. When is it a good time to start? And there's another very nice question on the diversification of investments. I thought that was very important because Shamli, both you and me, I don't think we spoke too much about the concept of diversification. So
Yes.
if that's okay with you, we can take both these questions. So on the first one, the question was, I haven't started early. When should I start? The answer is start today. And it doesn't, I mean, get on with it. As simple as that. Don't have to wait for a fall, so to speak. You will keep waiting, or even if it comes, then you will say it'll fall further. So whoever asked me that question, just go for it. You don't have to just start tomorrow morning. Reach out to someone, get to speak to a colleague, reach out to an advisor, get the process started immediately. It's like saying, uh, when do I start working out? Today, not tomorrow. So that pretty much is my most simple answer. On the question of diversification, I think that's a really important one. I'll give you my personal example or experience on this one. While I was working, so I used to have an income. There was salary, bonus, whatever, stock option, etc. So my risk appetite was very high. So I could invest 100% of my money. In fact, it was 98% of my money was in equities. Uh, I mean, of course, because I understood that it creates wealth. I was willing to take any amount of risk, etc. But there was also a salary. But now that I don't have a salary and I am now dependent on my investments to throw back cash, my investment diversification has changed. Now I have almost 35% of my money in bond funds. And that 100 jo hota tha in equity has come down to 65%. So it's almost looking like a balanced fund. So it's come to 65-35, but it's taken some time to reach there. And it came with the advice of my advisor. It came at a stage which is at different stages of life. But the concept of diversification is truly important because this 30-35% fixed income is like an insurance policy. It's something where if the market's tanked, it allows me to walk in, invest. It's like cash, right? So that is the point around diversification, that everything in your portfolio cannot be going up or down at the same time. If it is, then you're not diversified. Something has to go up, something has to come down. And that's what balances out the portfolio. Because in the world of investing, like Shamli explained, you have to live to fight another day. If you've fallen 50%, you have to make 100% to fight back. So the rule of investing is fall less. The number one rule is just fall less. If you fall less, you will kind of live to fight another day. And the way to fall less is diversify. And to diversify, you again need someone to help, de-jargon all of it and look at life objectively and guide you. So the first question, please start tomorrow morning. And second, do diversify, because diversification is like insurance policy.
Absolutely. There's another question, Karan, which says, I'm 25 years old. What percentage of my salary should I start? This person, Elizabeth, has just started her career. What percentage of her salary should she start in the investments?
So many things have to be answered, whether she's on rented accommodation, etc., etc. So I'm just giving a absolutely, random answer. What worked for me, I think, what worked for me when I was 25. I think I started investing 15%, around the 15% of my salary. 15, I think, if I remember correctly. At least that's what I started with. And then it kept going up. I mean, it didn't come down, it just kept going up, perhaps 15%. I will make this even simpler. In mutual funds, and I think, correct me if I'm wrong, Shamli, do you allow investments up starting from 500 rupees?
Yes.
Right?
SIPs can start with 500.
Yeah, right. So
But
now
we have, that is in ELSS, but we have 1,000 rupees. But today 1,000 has lost.
let's just take 1,000 rupees. And I don't mean to be demeaning out here or to be condescending, anything. Please don't get me wrong here. My answer is it can start with 1,000 rupees. It doesn't matter. What matters is the signing and the KYC and starting, because it's like opening the door to the future. Please open the door. Amounts are immaterial, at least to begin with.
In fact, I started with 1,000 rupees.
Yeah, I think I'm surely I would have
Years.
started. When I say 15% of my salary, that probably meant 1,500 rupees.
Just one, we'll take one last question for paucity of time, and if there are more questions, we will answer them. Maybe we will get back to you on your personal, we'll DM you. There's one question on whether an Indian investor should diversify outside India in international stocks.
Yeah, I'm an advisor to a firm, to a platform which is now investing globally. Absolutely. And the funny part is that this last decade has actually belonged to the US in that sense. So while India has delivered, but the last 10 years have belonged to the US. And I'll tell you the reason why this diversification outside of India works is because sometimes frontline technologies we don't get to participate in them in India. Like for example, Flipkart's still not listed, right? Baiju's is still not listed. You don't get to play those themes yet in India, and hence this global diversification definitely makes sense. So, and this comes into the overall scheme of diversified portfolios. You take a country risk, but you take many countries ka risk, so risk comes down. And there is absolutely no doubt that having part of your money in global portfolios makes a lot of sense, and some of these portfolios have done really, really well. Couple that with great stocks in India, and you look at the portfolio, I mean, it just tends to, and it reduces risk, it reduces volatility.
It does. It does.
That's the
I think we will wind up right now because we are actually short up our time. Just few mandatory things that we needed to talk to you about. There is a very simple process of eKYC. How to get started now? I'm assuming some of you are not mutual fund investors. We just need very, very basic documents for KYC, which is know your client. And most fund houses have eKYC. You just need to do your KYC and you can log into any of the mutual fund apps or maybe even a CAMS app or an RNT app. You can invest through the exchange, you can use MFU. There are various ways to invest in the mutual fund. So the only thing we need is you need to do your KYC once, and all fund houses will call you KYC compliant. So you don't have to sign 100 pages and do a whole lot of documentation. All mutual funds which are there are registered, but they are governed by a government body. There is a concept, so you don't get certificate, you get something called an account statement. And please do opt for email-driven account statement because it is more environment friendly. So you will get an email of your account statement. You will get a consolidated account statement in case you should choose to invest in more than one fund house. There is a redressal team. You can, if you have any complaints, you can write to any AMC. There is a redressal committee in all AMCs or asset management companies. And if you or should you need to change your address. You just need to submit those, only the relevant documents again to the fund house. Now, these are these important things that you need to know, that it's not a very complicated process to get started. And I hope we've been able to convince you to start tomorrow. And start small, it's okay. But stay the paths and diversify, stay the paths. And I'm sure most of you, of course, will become millionaires, but some of you may even become billionaires. And on that note of optimism, thank you so much, Karan. And thank you all. And we'll get back to you with the answers should you have them. Thank you so much.
Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.